I think one of the things that we are encountering is not just our views, but the views of our clients. The clients are evolving rapidly with regards to the respect around ESG, and having incorporated ESG tools in our investment process for many, many years, it's only recently that we have been asked by clients in almost every encounter we have with them to go into detail about how we use them, what we use them for, and the output of that. The next phase of this is most likely to be reporting around impact, and us reporting to our clients the impact that the companies that we're invested in are having on the environment, on society, and every other stakeholder that's impacted by their activities. So we do see a significant shift in this direction, and it is having an impact on the way that we are allocating our funds. Firstly, from the increased relevance of this, but also thinking about how these factors will impact commodity prices and therefore value that we see in the market.
And Evie, just before we leave you, I know you have investors, US, but also Far East. Do you see any differences in the intensity of this debate across different regions?
That's a good question. So we have a variety of, we have a very much a global client base, as I'm sure everybody else does. And without a doubt, the highest area of interest in this today comes from Europe. And I think after that, it would probably be in Asia and then the US. But I'd say those latter two are catching up very, very rapidly. And I think it's part of our fiduciary responsibility to respond to their needs. And as those needs change, the way that we allocate capital will adapt. And what we're trying to do is to stay ahead of that curve. So I would say, in summary, it's a global trend. It's not focused just in one area.
And just thank you, Evie. Just moving on to George. In addition to running the Gold Fund, George has been involved in developing some green or ESG funds, specific funds. George, can you talk about how you construct a portfolio in that context, given that it's not as simple as the marketing brochure can make out, i.e. a metal, for example, like cobalt, which clearly has a green usage at the end of its life, may in fact, in its mining and its processing life, be anything but green. So just give us a little bit of an indication of how you actually are choosing your investments in the green and ESG funds.
Yeah, the fund you're referring to, Fiona, is the Global Environment Fund. It incorporates ESG clearly in the process, in the way we look at companies. But the fund is what we would call an impact fund, in that it is pursuing decarbonization and really trying to take advantage of the growing need for investment in decarbonization due to climate change. So we filter and screen the whole universe for companies which will have an impact on decarbonization. And we report on each of those investments exactly how they are using their technologies or improving emissions output in terms of decarbonization. So we take into account the full life cycle within the company, and we're looking for those with essentially a negative carbon score.
And both of you remain at this stage active fund managers, is that correct? As opposed to the huge passive funds that are building up globally.
Absolutely.
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 And I think in that context, and with the increased interest in ESG and how companies are performing, I think as active fund managers, we have a more important role in engaging with companies in terms of how they're performing and reporting that back to our investors.
But also within that, it's important to point out that the weight of money that's flowing into products in this area, whether they are passive or active, will shift the cost of capital for companies. Because if more money is flowing into, if it's a passive product that is controlled by a series of restrictions, then that weight of money will adjust demand for securities.
And with implications for those less, at the moment, looking like ESG contenders, yes. We will circle back to London in a minute, but I'd just like to involve our two South African panelists. First to Myron. Now, Myron doesn't have a choice. He has to hold South African mining stocks in his role, and he also has to make sure he gets an income for his fund beneficiaries, so perhaps dabbling in what are increasingly being seen as sin stocks. Myron, could you articulate your domestic view on South Africa's investment landscape and possible opportunities of mispricing of South African mining stocks going forward if we have an excess of box ticking by the global passive investors?
Great. So the way MIBFA and I look at investments, right, we take a very long-term view. And if you look at the really long term, South Africa gets about 8% real return over 100 years at least, right? Now, you wonder why that is, right? I can think of 3-4 reasons why that is, right? And these reasons make South Africa a pretty good destination for investments, right? Now, firstly, in spite of all what we might think, the rule of law is obeyed and listened to in South Africa, right? I might be a little bit critical of the ANC government in this way, right? They're a bit like Winston Churchill's quip about the Americans. They always do the right thing, but first they try out all the alternatives, right? So the ANC government eventually does the right thing. I mean, even about that coal discussion yesterday, it was a robust discussion, but the coal companies have the courts to return to if they need to, right? So it's okay to have robust discussion. So the rule of law is obeyed, and that's great as an investor because property rights are listened to, right? Secondly, we have a commodity mix in the South African index, and inflation can be very bad for high inflation, can be bad for equity returns, right? And it's well documented. It's disastrous for bonds, but bad for equity returns. And at the times of high inflation, to have commodity stocks is a good balancing act in the portfolio. And that's why countries like Australia and South Africa have done well, whereas countries without commodity elements don't do as great. And lastly, there is the element of mispricing in Africa because people can get over-pessimistic as well. There are some risks, and you price those risks. And once you price those risks, there might be opportunities in South Africa. And in some sense, the reasons why, in a country like South Africa where you've had apartheid for such a long time, and you've had what our president calls the lost decade in the last 10 years, we still have had good returns because capital doesn't sometimes come rushing in. And when there's a limited supply of capital, the return on that capital can be quite high. And also the fact that we're geographically separate from the rest of the world means the capital gets good returns in South Africa. So the way I see things, and maybe I'm a bit of an optimistic about South Africa, there are good returns to be made in South Africa. Within the mineral sectors itself, it's well understood that some sectors are likely to do better than others. The commodities that sort of supply to China, given that they're slowing and they've overinvested, might not do as well as some of the PGM commodities, which seem to be in demand at the moment. So I'll leave it at that.
If we go towards a carbon-free future, there is a cost. Now, Europe and America is in a strong position to maybe bear that cost, but a lot of emerging countries aren't. And that's what Minister Mantashe was talking about, that there is actually a trade-off when it comes to these costs for countries like in Asia and Africa, of, you go the environmental costs, you spend that, or do you spend money on trying to eliminate poverty? And so there are choices we have to make. And there is a danger that the environmental sort of policies crowd out very necessary social policies.